It's not the last lesson of the course, but it could be. Of all the concepts that will be important to every client, every Halon engagement, and every accountant doing S-Corp tax returns, officer compensation is probably the concept and the thing that will stand out. This is because, as you know, the self-employment tax that the client will pay is completely dependent on the amount and the viability of the S-Corp structure that it follows so closely. While some accounting pundits and conservative accountants will say that the S-Corp is not really about self-employment tax, I believe that's really just all talk. I think that the S-Corporation is about saving money on taxes. I believe that is why it was created. It was created so these corporations did not have to feel like they were professional companies where their work is only the service that they're providing. I think that it was a huge boon for companies that provide something other than professional services. The reality on the street, the reality that you have to work in is that self-employment tax is a big part of why people elect this type of status. The other folks who think it's very important, they work at the IRS. They want to make sure there are not any, what we'll call piggies out there, taking advantage of something in a negligent or a greedy way. So, given all of the folks that have eyeballs on this, we have to do this right. And I'm going to show you the process you should follow for every Halon return so that we're in compliance with the standards around officer compensation. Let's get started. Now, I said standards around the notion of officer compensation because there are no specific instructions within the law. The law says all S-Corps must pay officers reasonable compensation. And that's really it. That's all it really says. We're left to guess at what that means. Most practitioners use case law. Case law is the results of tax court cases about officer compensation as a guideline to follow. It's not foolproof, but it's better than nothing. So in the absence of real concrete law, we have to use rulings and kind of look at how the courts interpreted this idea of reasonable compensation. Our Halon system that we use for coming up with reasonable compensation in this compensation matrix is based on such law. It's also based on some investment theory about capital and how businesses are funded. When used together, we have a fairly strong case. Again, I say fairly because anything can happen in court. All you can do is put your best foot forward, and that's what we're going to do, and you're going to rely on my almost 2 decades of experience in doing this as a good example of what works and what doesn't. Overall, the court cases that we're going to rely on looked at several factors and created kind of a scorecard of what was important. The worksheet we're going to use for Halon does something similar. Some of these factors that the court weighed in evaluating reasonable compensation were the employee's role in the company, a comparison of the compensation paid to similar employees, other employees in the company, the condition of the company, the structure of the compensation, salaries versus shareholder distributions. This is an important one. How much was distributed to owners versus how much were the owners paid via salary. They looked at size of the company, economic conditions of economic conditions of how the business operated in, and even more. There's if I look at all case law, there's probably 20 or 25 factors that the IRS in the past over several cases has looked at. The bottom line here, as you can see, there's very little that is specific about any of that. What protects your clients and us is using a procedure for each of them that measures several factors and can be used as support for our calculations. The Halon compensation worksheet does that. It is a document that if we have to prove how we came up with the compensation for the company, we say, here it is. This is a multi-factor approach we took, and here's how we calculated. Just having it be something we calculated versus pulled out of thin air puts us ahead of so many millions of S corporations that do this. Okay? I put on the screen some of those that I listed out. Let me show you and get into the worksheet now. And here it is. This is the spreadsheet and the worksheet that you'll complete for each client when they first become a client and you're trying to decide what you're going to set their salary at. This is one document that I've, on the screen, I've cut into two parts. You can see the top part on the left and the bottom part on the right, just so we can kind of look at it all at the same time. There are three main parts to it. First is the matrix-based annual salary from the officer's compensation matrix that I'm going to show you on the next slide. This is the matrix-based annual salary is the minimum salary that the client can have to qualify for Halon Defender insurance. It's based on something called the independent investor test, which I'll show you soon. But think of the matrix as what it needs to be no matter what. That's for two reasons, really. One, it's so that the insurance covers you in the tax return. But two, there's a reason we made it the minimum. So there needs to be something when these companies make money, and the minimum matrix salary is a kind of a testament to, hey, we know there's got to be a minimum, and we calculated a minimum. Here's how we got there, and I'm going to show you more about that here in a second. The second piece is the BLS estimates. This is using the Bureau of Labor Statistics, a government agency, to see what market rates are for the type of job your owner is doing. We also measure the hours worked and apply a rate to find what the salary would be as a BLS estimate. So we're kind of calculating the salary two different ways, one with the matrix and one with Bureau of Labor Statistics estimates. And then the third piece of this is the financial and environmental factors. These could raise or lower the BLS estimate. At no time can the salary go below the matrix amount. So the matrix is the absolute minimum. If the BLS estimate raises what the salary should be, environmental factors can also raise it above or below that amount. I'm going to show you how to complete each section of this, but first let's start with the matrix. It's important that you understand how to use it and where it comes from. As I said before, kind of always think of the matrix as the minimum salary that can be run. This is what I'm showing you in the slide is just the top part of the matrix. The whole thing is in the downloads to this lesson. So the worksheet, everything that I'm showing you here today is in the downloads of the lesson. As I showed you in the very first courses, in the marketing side of this, to use it, you start with the estimated net income of the business before officer compensation is paid. Then you go over from the left. See, you've got the net income here, and you go over to the left and see what the minimum payroll for that range is. This is the lowest amount of annual payroll the company can run on its officer owners. If you have two owners, and let's say you've got a business that makes $35,000 to $40,000, but it's owned by two people, you could split this $13,000 up between the two of them, $6,500 and $6,500. Okay, it's just what the total needs to be across all of the owners. It doesn't matter who gets paid what, I'll leave that up to them, but the total needs to be there. The worksheet may raise this amount. It may not. But this is always our starting place. So our worksheet starts with whatever this payroll amount needs to be. Let me show you how these amounts are calculated. It's interesting, but it's also important for you to understand so that you can explain it to clients or anyone else who might ask. And for this part, I kind of, I kind of hope you like numbers, because we're about to get into some right here. There's a lot of numbers here, and there's going to be some calculations going on. So this is how the compensation was calculated at different net income amounts. You can see each column here. Let me get my highlighter out so you can see this a little bit better. Each column ends with an officer compensation amount. These amounts match the matrix. So what goes on up above here is the calculation, okay? You can see each column, and it goes all the way to 180,000, where our officer compensation matrix kind of ends here. At least it gets very close to the end. First, let's talk about the theory behind this, okay? So let's say we're going to invest in a company. You have money, and you're going to buy the entire thing, okay? What rate of return would you require from the company in order to invest those dollars? Well, I can tell you, the smaller the company, the more risky it is. So we're going to require a very high rate of return on small companies, and that rate of return is going to be less and less as the company gets larger and larger. That's kind of, it's just a basic investment theory, that the smaller the company is, the more risky it is, because the more risk there is of it just completely closing down because it doesn't do that much business compared to a large company. That's where the ROI percentages come in here. So you see these ROI required, these percentages. The smallest company here, this one with net income of $15,000, has a 20% ROI, versus the one with $90,000 net income has a 12.5% ROI. As kind of a frame of reference, the S&P 500, the stock market, averages about 8% ROI for billion-dollar companies. So we're in a very reasonable range here, going from 20% all the way out to 12% in our matrix. Next, we have to figure out what the value of those companies are. That will tell us how much we have to spend to buy it. That tells us the fair market value and gives us an idea of what our investment return should be in dollars. So in this, we say that every company is worth 4 times what their net income is. And this is actually very conservative. Many companies sell for much more than 4 times their net income. So for our $15,000 company here, 4 times their net income means their fair market value is $60,000, which just means you could buy that company for $60,000 if it made net income of $15,000. That is very likely. That is a fairly conservative multiple, at least conservative from the standpoint of it's fairly low. There's many companies that sell for much more than that. On the $90,000 company, you can see 4 times that means it sells for $360,000, 4 times 90. The fair market value is, again, what I would have to pay in cash to own that company. Whoever started it would sell it to me for that. Are you still good? Okay. So now we have to figure out the ROI dollars. Okay. How much the ROI dollars is what the business has to pay me based on what I purchased it for. I'm going to purchase it for X. This is the ROI that I need in real dollars to make this investment work. So for the $15,000 company, I buy it for $60,000. I require a 20% ROI, which means ROI dollars is $12,000. What this means is if I own this company, of the $15,000 it makes, $12,000 of it needs to come to me as a return on my investment, because I required a 20% return to invest this $60,000. Does that make sense? On the $90,000 company, 12.5% of $360,000, which is I bought it for $360,000, means right off the bat they have to pay me $45,000 as a return on my investment. Does that make sense? So next is the next piece of this here is the retained dollars. The company has to retain some money to invest in equipment, in cash flow. Some people don't pay on time, so you just have to retain some of the money that you make in the business. You may spend it on business assets. There's all kinds of things that you need to. I've made a very conservative estimate here on this like $15,000 company of $2,000. And you'll see the retained dollars don't move much. down here at the end, they finally get down to $3,500. That is a very low amount, but it's kind of a very conservative amount for how much these companies really would need to keep over. A $15,000 company, if they had to pay $12,000 to their investor, more than likely they're just keeping everything else. But finally, what is left over after the retained dollars is what can be paid as officers' compensation. Investors are paid first, then the company retainage, then officers. Here's the thing. People don't buy companies so that officers have jobs. Because imagine these are two different people. They don't buy the company to put officers into a job. The compensation of the officer is a function of generating return on investment. ROI stands for return on investment. So if they generate more, they make more. And the spreadsheet shows that, right? If the net income goes up, so is the officer compensation. So we're showing a matrix where if the officer can increase this business from $15,000 net income to $100,000 net income, their pay goes from $1,000 to $50,000. That is how the real world works. And really that's it. It is what it is not, okay? These minimum matrix amounts are not a guess or just trying to save on self-employment tax. That's not where I got it. It is a meaningful and thoughtful way to figure out what is financially feasible given the investment requirements. Does that make sense? And this is part of the matrix that's in the packet so that you can see this and kind of even explain it to clients. Here's how we're getting these numbers. If they ask, here's how we're getting at this amount. Okay? So that's the matrix. Now let's jump into the spreadsheet, into the worksheet, and see if our minimum salary needs go up or down based on all these other factors. So in the example that we're going to do with the worksheet, here's the top half of the worksheet. This example, we're going to use a $50,000 business as our client. They have $50,000 of net income. The matrix says, when we look it up on the matrix, it says the minimum salary is $21,000. So we're going to put that at the top of our worksheet. So that's filled in. And next, we're going to take a look at the special training required. Special training is things like special safety training, a plumber that's certified to work in kind of like skyscraper work, a mechanic that only works on like Lamborghinis. That you get the idea, right? It's something special about what they do and how they do it. If they have something like that, that can be something that adds to the salary in and above what a normal person in this same job would do. Our client in this example is a landscape architect. She designs settings for residential homes and does everything from small replacement projects to full landscape redesigns. However, she does not have any special training above and beyond what it takes to be a landscape architect. So we're going to put NA next to that section and kind of move on and say that that does not impact the worksheet at all. So we're still at $21,000. Now we're going to jump into kind of the BLS section of this, where it starts with this hours work. The first thing we have to figure out is how much time the client spent on each of 3 different activities. See how I've broken out activities as service and product delivery. So this is the actual landscape architect work. Then there's administrative duties, right? And then there's these marketing duties. And what we're going to do is we're going to discuss with the client when we're doing this worksheet how much time they spend on each of these roles. Like administrative duties is maybe something like billing or ordering supplies, and then marketing activity is probably on the phone trying to drum up business. We're going to discuss with the client how much time they spend on each of these. Our client has told us it's a pretty even split, but that she is not that busy yet, which is why her income's only $50,000. She says she's only working about 25 hours a week. She takes 2 weeks off, so we're going to work on a 50-week year. So 50 times 25 hours means she works total a year 1,250 hours. And she says that the split is 500 admin, 500 landscape architecture, and then 250 marketing. So 500, 500, 250. We'll get these amounts filled in and kind of move on to the next slide here. See how I've filled those in, and we're kind of moving forward here. So what we need to do next is figure out what the wage rates are. And for this, we're going to go to the BLS website. What I'm going to do now is I'm going to pull up this BLS website and kind of take you through how we're going to find the rates of each of these services. Okay? Hold on. All right. So here is the Bureau of Labor Statistics website. Your tax dollars pay for all of this information gathering, so now we get to use it. This is at bls.gov, okay, right up here on the top. And under subjects, we're going to go to national compensation data first. I'm gonna kind of show you one option here is there's several pieces to all of this, and you can come into the reason I wanted to show you the national compensation surveys. You can actually come in here and look at the actual surveys. But what we're going to go to is we're going to go to wages by area and occupation. Okay? Because this gives us over 800, it's kind of sorting that national compensation survey. And we can search it by occupation, we can do it by industry, we can go in here by state, metropolitan areas. But what I'm going to do is I'm just going to start with the over 800 occupations here. And what it does is it gives you several kind of ways to sort this data. But here's the big data table down here. And here's a trick. Instead of really trying to get into all of this, just come here to the filter by the table by text. And I'm going to start typing in like landscape architect. So I'm going to start typing in and see how it came up with, and here we are, landscape architects, okay? There's 19,000 of them out there, and what we're going to use is this median hourly wage. You could use the mean hourly wage if you want to. I tend to think that the mean is skewed by the numbers of people who probably call themselves something like this and have some obnoxious wage. I use the median. You can use either one. Sometimes one will be higher than the other. I usually go with the median here. So the median hourly wage for a landscape architect is $31.62. So I'm going to remember that. Okay, so I'm going to write that down in my book here that's in front of me and write down $31.62. Okay. Now next, I need to look for the office, the admin wage. So I'm just going to type in here office. And what I get very quickly right down here is the office and administrative support occupations. Now you can go into some detail down here if you want to, but I'm going to grab, just for this example, I'm going to grab this median hourly wage of $16.70 right here. Now, if you were to ask me, I know for a fact that there's a lot of companies that don't pay their people $35,000 to do office and admin support, but this is what it shows, so that's what we're going to use. So I'm going to write down $16.70 for my second wage rate. Then I need to take a look at marketing. And what I usually go towards is telemarketing, because I think most people do a lot of this marketing over the phone. You're trying to meet people whenever you're getting a referral and you're calling them to quote them. All of that tends to happen on the telephone, right? So I go to this telemarketer right here, and the median hourly wage is $11.76. So look at that. So marketers are paid less than the office admin. I would bet that in most businesses, these are very similar wage rates. It's 11 or 12 bucks. But anyways, let's use that as an example. So $11.76, okay? So I have all three of my wage rates. Let's plug that into my spreadsheet. Okay, so we're back to the worksheet, and as you can see, I've plugged in all of our wage rates here. $31.62, administrative $16.70, marketing is $11.76. If you want to print out that data for like these two, because these two probably won't change very much. Whatever you decide to use for these two wage rates probably won't change much between clients, because they're all going to be kind of the same thing. So if you want to print something out and hard code that into your spreadsheet, that's fine. This is the important one that the IRS wants to kind of understand, and documenting what the client says their activities are here. It's the right thing to do. So we've got this piece filled out. Now let me move forward and we'll take a look at the bottom half of the worksheet. So I've done the math, okay? And for the service or product delivery, it's $15,810. See, I have 1 times A, 2 times B, 3 times C. I've tried to make this as easy as possible. The administrative duties, I still think these are a little high, but $83.50. And then the marketing duties, $29.40, which means that the BLS salary is $27,100. Okay, so in the absence of any other changes, we probably need to show that this is $27,100. But as you can see down here, I have a little bit less, and I'm going to show you how I get there. So the first thing we need to ask ourselves is, are there other employees? If there are, what are they paid? If it's more or less than what the officer is paid, we probably need to factor that into our adjustments, because normally the CEO of a company is not going to make less than someone that works for them. I mean, maybe they could, but not often, and it's going to be a hard thing to support. So if there's other employees, click yes, and you need to kind of show that you have factored in if those other employees make $100,000. Because if they do, you're going to need to adjust the officer's compensation up based on that. But in our example, the landscape architect, she does not have any other employees, so we are going to say no. Okay? The next question is talking about capital, meaning, does this business have a bunch of equipment it makes money with, like big backhoes or haulers, or some machine that does a whole bunch of the work of a product or something like that, trucks or whatever. This would indicate that the income attributed to that capital, those machines, should not be allocated to the officer, because it's the machines making that money, not the officer. So that would go to reduce what the BLS salary shows. But in our example, she does not use a lot of machines. I mean, maybe she might have some fancy landscape architectural software or something, and maybe you would say yes, because if that was really expensive, and that would reduce some of the salary sum. But in this case, I'm also going to say no. So we're going to check mark there. Finally, there is income from cost of goods sold or inventory. Now, this is going to be a yes, because part of her income is from cost of goods sold, where she's reselling plants to them. And this means that income that was generated from selling items was not generated by the officer and could go to reduce the salary. I'm actually going to say that her salary is lowered by $2,000 because she has significant cost of goods sold income that is affecting it. Now, how did I come up with $2,000? Right? That's your question. Well, how do you calculate that? There's no way to. It's just a feeling. You don't have to lower it if you don't want to. The conservative thing would be don't ever lower it, based on what the BLS is. But if there's reason to lower it, I'm going to do so, and I'm going to do so in a material but not so material way. You could say that for each of these, there's a 10% increase associated with it if you want to. Come up with some valuation on your own. I'm just going to write on the actual document that because this was yes, I lowered it $2,000, and I think that's reasonable. The main thing here is that we're documenting what the circumstances were that led to the lowering. Having this worksheet is going to be gold in an audit, because no one has this kind of thing. The IRS chooses to audit folks who just paid very little salary and have no rhyme or reason, no documentation of how they got there. So at this point, as you saw earlier, we're at $25,100. If there were other factors that have not been taken into account in the whole worksheet, then you would put them in this other factors section and write out what that does to the salary. And I mean, I don't know what the other factors are, but if there's just something odd or unique about their situation, you can put it here and raise or lower it based on that. In this example, I'm going to leave it at 25,100 and save this to the client file so that we have it always. And this is what I'm going to run. I'm not going to run the minimum 21,000 that the matrix showed. I'm going to run the 25,100, and I'm going to feel pretty good about it because we calculated all of this. Does that make sense? That is the worksheet. That is it. That is you calculating officers' comp and doing it in a very methodical way. Now, as I said earlier, S-Corps and officer comp, it's a really hot button issue. I mean, it's going to be forever. Many CPAs and tax attorneys, they argue day and night over what is the best way to handle compensation and self-employment tax and all of it. There's companies, you're going to see a company called RC Reports at some point that has an actual software that will show you what someone should be paid. It's sort of similar to what we're doing in this worksheet. So, the IRS has seen that kind of thing and said, yeah, this will work. So that's why we're using this. I can assure you, you will never, ever really feel like you have it cut and dry. Businesses are moving targets, right? Their income and expenses move around all the time. So you just have to kind of get comfortable with the idea of, well, we're doing the best we can, but nothing's black and white. Also, a little caveat. Let's say the S corporation makes $50,000, but doesn't distribute anything to the owner, keeps it all in the business. Then there is a case that could be made that it doesn't have to run officer compensation either. There's some rules within the IRS that say distributions can limit what the compensation needs to be because none of that money is leaving the business. Now, the reason I didn't make a big deal out of that, and I'm just mentioning it kind of here at the end, is because most of your clients need that money, right? They can't just make $50,000 and leave it in the business and never take it and spend it personally. So most of your clients are going to need to run payroll the way that I've just shown you. But if you come across someone who's like, I make money through other stuff, just don't distribute any of it. I'll just hold on to it for later. Whenever they do distribute it, they're going to have to run payroll because it's going to have to be done at some point, but it doesn't have to be done in those years where they don't take distributions or can be limited based on what the actual distributions are. The reason this is all important and the reason I created Halon Defender and the Matrix is so that you've got a backstop in all of this uncertainty. Run the numbers as I've shown you here in this presentation, in this lesson, and do it for every client, and you're going to be just fine. If you run into a weird situation, something that doesn't fit the normal, worksheet, contact us at Halon, contact support, and our team will help you kind of think through this thing. And always make sure, and this is the last time, well, it's not the last time you'll hear it, but always make sure you run at least the matrix amount. I'm telling you, that's going to protect you in so many ways. Just making sure payroll's not zero is a big step in making sure we run these S corporations the right way. Okay? That covers what I wanted to cover for compensation. Let me jump into the action plan here. So, what are you going to do with this? Talk to your clients about what they do, how much time they spend on it, so you can fill out those portions of the worksheet. Then also use bls.gov to find those rates and complete the worksheet for each client, save it to your file. Now, if you forget to do it and you just end up, going for 7 months with a certain salary, you probably better stop what you're doing and at least do it then, right? There's nothing that says if you forget to do it or you don't do it in the first 5 months or even in the first year, there's no reason you can't do it now, right? And if the salary changes, let the client know and say, hey, we're changing the salary now, right? So don't be afraid if you didn't do it at the beginning that you should never do it. Do it as soon as you can and keep these things updated in case the income changes or, you have to change the salary. Have this document backing it up. Always, and finally, always ensure payroll is above the minimum in the matrix. right? In the Matrix. It always reminds me of that movie, right? But they're very different things. But at any rate, make sure that your payrolls are running above that minimum so that you're all taken care of from an insurance perspective. And that's it. Officers' compensation's wrapped up. You know what you need to know. I have a couple of lessons left. You're almost done, but these next 2 lessons are going to be doozies. I will see you over in them.